Friday's sell-off has definitely started to break the short-term base case. It was the first time in a long time where sellers actually dominated the intraday action. However, and I know some people might not like this, there's really nothing broken on the higher timeframes, at least not yet. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, we've got a solid red-bodied bar with very minimal upper wick and hardly any lower wick as well. Really weak close from the sellers, dead on the lows of the overall weekly range, which we know is largely due to the Friday move in the downward direction. In terms of immediate structure, the sellers do get a check mark there. If we're thinking about location on the bar-to-bar count, though, notice that we did technically make a higher high. We did technically make a higher low. Is that inherently bearish? The answer to me is absolutely not. So you've got a mixed bag of opinions on the bar-to-bar count, so let's just zoom out and consider the overall weekly trend count, where we have lows, we have higher lows, firm higher lows, firm higher lows. This is starting to act as the next higher low in the trend sequence, and the question I would pose is, where are we pulling back from? We're pulling back from the highest high in the weekly trend count. So is there any damage to the weekly trend here on this view? I mean, the answer is absolutely not. So in the intro, when I say, like, things really haven't degraded on the higher time frames, this is exactly what I'm talking about. In the grand scheme of things, all we've done is really perhaps test outside of this balance range on the weekly in the upper wick and fail back into the range. In theory, as long as a higher low persists at the bottom end of the range in here, closer to that 595 level, I wouldn't really say that the weekly is in jeopardy of, oh my goodness, a big crash is coming. Now, of course, we'll have to change our tone on the weekly time frame chart if this low gets taken out, in which case I would really just expect what? Equal lows here on the weekly time frame, closer to the 580 level, in which case we can start to have the conversation about possibly some sort of double top. But remember, here at the Trade Brigade, we call things at face value. We would require the double top to trigger underneath the neckline before we get aggressively bearish, which would mean a weekly close below 580. Has that happened yet? No. Could it happen soon? Perhaps, but we're just not there. Let's take a look at a couple of additional indications, which I think are pretty compelling here as well. If we look at the anchored VWAP cluster, yeah, there was a nasty pullback on Friday, but from the weekly perspective, we're still above the entirety of the cluster. If we bring out the Fibonacci's from the bottom of the move down here, all the way up to the new highest high in the trend count, the all-time high from earlier on in the week, all of this is still taking place above a Fibonacci 38.2, which really should not be that shocking. But if we zoom in, how about this Fibonacci perspective from the most local low up to the high? Where are we? We're above this Fibonacci 38.2 as well, which is great confluence with the anchored VWAPs on the weekly also here, much closer to 598, 599. So one more time, when I reference in the intro, is there anything going wrong on the higher time frames? The answer is no, objectively, based on these price levels that we've just walked through and the overall trend. But as we start to take it down to the daily time frame chart, this is where things change just a little bit, maybe more than just a little bit. Let's firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. What do we see here? If we're contained by the upper bound, the number's at 611.20, and that, of course, is a lower high underneath the all-time high, suggesting the possibility of a trend reversal. If we take a look at the lower edge of the weekly expected move, it's at 588.69, implying certainly a lower low from here to here, and absolutely continued price acceptance underneath the top end of the range here, which is at 606.75, which brings me to my next point. Now, in the Wednesday update video, we made a point to say, like, hey, nothing's overly bearish yet, but we also were pretty clear in calling out that 606.75 needs to be the next higher low hold. And as of Thursday's close, things were looking pretty compelling for the bull case to live on. The reason I would say that is because Thursday produces a hammer candle where we look underneath the Wednesday low, underneath the Tuesday low. Remember, it was a shortened holiday trading week. We don't have Monday. But we tested 606.75. We perfectly found support off of that level. And then where did we close on Thursday? This is important. Back inside of the Wednesday range over the Wednesday opening print. So as of the open on Friday's session, there wasn't anything inherently wrong with the trend. It's the fact that Friday got so much follow through to the downside that starts to become concerning, right? And it's primarily the acceptance underneath the Thursday low, underneath the 606.75. If we're considering the SPY daily time frame trend, remember that the base case outlines that we have lows, higher lows happening here, higher lows happening here, and since we made a move to the highest high in the trend count, we said that we could afford a higher low somewhere over the top of 606.75. This is a rehashing of what we talked about on Wednesday, right? So again, Thursday looks fine there. But as soon as we break this, what starts to come into play? Now we have an equal low on the daily time frame chart. We are no longer in a firm daily uptrend. The risk is real now that any semblance of a lower high, perhaps underneath 606.75, has the potential to cause much further downside in the market. Something, let's not get crazy here, but the CPI gap close down below, it's within striking distance. It's not off the table. It's at the lower edge of the weekly expected move. And if things are really going to heat up, keep in mind we have NVIDIA earnings on Wednesday. If things go poorly with that, and of course, we can have the optimistic take and say, what if things go better than expected with NVIDIA on Wednesday? And we'll get to that in just a moment. But for now, with the breakdown of the trend on Friday, this is within striking distance. So the base case has sort of fallen out of favor ever since really intraday on Friday. We had started to see price acceptance underneath 606.75. Now, am I a big bear here? Oh my goodness, the market's going to crash and burn and go to zero. Not really. If you take a look at where we've closed, again, it's an equal low, so the trend is starting to neutralize. The 50 SMA on the daily time frame chart has started to support price action here. And if I think about what's happening in the grand scheme of things, right, if this is a balance range, we start to see it look above and fail back in the range. Really, the target could be the bottom end of the range, 595.85. And if we find buyers down here, then the market just remains range bound. And as we were starting to get these bullish indications, we might have to dial that back a little bit and say, okay, the market's range bound. We're not going to have this bullish and aggressive stance looking for the daily uptrend to continue. We're back inside of the box. It's just, as we were saying, for what felt like eons. Really, the majority of the January timeframe and even early February, every single trade is its own trade in isolation. It's a volatility box. We don't really have a clean daily trend. It's almost like we have to start falling back into that mentality here. So that's the general commentary on what's happening with the SPY trend and the reversal from the Friday session. One more time, I think that a real risk to keep the market more bearish is any semblance of a daily lower high underneath 606.75. I would truly carry that forward as a key and instrumental level on the daily time frame. Of course, any continuation in the downward direction should seek the bottom end of the balance range at 595.85, and any Brigade bolts underneath that, we can talk about the concept of overhead supply, really starts to weigh on price action. The next major target is the unfilled CPI gap from 589.25 down to 584.75. What I was talking about with overhead supply is simply the concept that if all of the traders who are long inside of this box are going to be disappointed, it comes from a breakdown of 595.85. Everybody, even the traders with the best possible trade location, because remember, we had the DeepSeek news over here. A majority of traders bought this action. We only had one day underneath 599.65. Majority of traders were above that. This is tariffs at point number 2, right? Tariff round 1 at least. A majority of traders interacted with the market above that 599.65 level again. So if we start to see price acceptance under the 50 SMA, underneath the low basically of Friday's session at 599.65, that would start to indicate that a majority of this range is overhead supply. It's confirmed when we start to get this lower high underneath 595.85, which just wipes out the lows from each one of these interactions that we had seen in the past on the major gap down. So the three key levels, I would say, if you're only looking at the daily time scale, 606.75, 599.65, 595.85 here are your three key areas on the SPY daily. If things are going to get better than expected, if better outcomes happen maybe on NVIDIA earnings, I would love to see a higher low back above 606.75, but as we'll see walking through the supporting evidence, it does look like there's starting to become a little bit more of a serious turn here in the market for at minimum neutrality, if not a little bit more of a bearish edge. So let's drop it down to the hourly time frame chart, see what else we can learn from the price action perspective here. It's very clear on the Friday session that it was a straight down move. There was no intraday two-sided trade. It was sell, 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 sell. It was a big OPEX as well, so we'll keep that in mind. But the point being is that if you take a look here on the Thursday lows, right, this is exactly where we wanted the next higher low in the daily trend count based on all of these interactions in the past. It looked pretty good opening above this level on the Friday session. And if we really want to go through the exercise of like, okay, Matt, how do we use these levels in real time? Let's just do this exercise very quickly in today's episode. If we take a look at the 5-minute time frame chart, what's the first indication that things probably weren't going well on the Friday session? I would say it's the lack of hold outside of this afternoon consolidation from Thursday, right? Friday's open is up here. It's this red bar there. As soon as we started to get a lower high on the 5-minute, and it depends on your time scale. You don't want to get too granular if you're a swing trader, just like you don't want to get too zoomed out if you're an intraday scalper, right? So this is the first sign that things aren't going well. It's acceptance back down inside of this range. If buyers were truly going to run away with this, and we know, right, headed into the Friday session, buyers absolutely had the edge opening above this box. So this is sort of like strike number one. Strike number two is when we approach the low of the Thursday session, there's an overshoot. If we had stronger buyers participating in the market, there shouldn't have been an overshoot. So, okay, let's give the buyers the benefit of the doubt. We see a move back into range. As soon as there's another move underneath 606.75, which keep in mind is the key daily level, it's also the Thursday low of day, this is strike number two. Strike number three is just as you continue to break these levels to the downside, okay, like there's no reason to be fishing for longs at that point in time, right? So even in hindsight, right, we could start to say, okay, maybe this was a bearish Brigade bolt underneath 606.75. So as you're judging the base case, we've been talking about this concept of base case on the daily time frame chart for a number of weeks now. As you're judging that intraday, right, and the point is to judge it intraday, what's happening right here, right now. As you break underneath Thursday's low, that's a red flag. As you move underneath the top of the 2-day balance range from Monday and Tuesday of the week prior, that's a red flag. Underneath the lows here, right, that's a red flag. So these things, as we walk down, right, it should have been, okay, huge caution underneath the Thursday low. Anyhow, let's get back to the hourly time scale here because there's a couple of things I want to point out. If we take a look at the Fibonacci's, I mean, clearly from, let's just say point A to point B, it's been a 100% retracement. The first thing I would say about that is typically when you have a 100% retracement, it's very rare that the market just crashes right through the level without some sort of what we would call a dead cat bounce, right? So what we would want to measure is just where is the bearish Fibonacci 38.2 that keeps the bears in control, right? This would just technically classify as bear flag consolidation from this perspective here. Note that the 38.2 is of course underneath our key daily level at 606.75. So that is a pretty big red flag in the sense that, okay, any lower high rally attempts that reject there continue to look bearish. You could clearly start to, make the argument for the pattern here that this also suggests some sort of head and shoulders, in which case your neckline is that key level we described on the daily at 599.65. So you can see how these data points start to stack together. We can come from the bottom of the move here up to the top and just make note that we are at the 61.8, which would be the neckline of supposedly this kind of not inverted, but rather regular head and shoulders. If we were to take that out, we always know that the 61.8 is the line in the sand. Anything or continued price acceptance below that level, which aligns with 599.65, should suggest what? 100% retracement has a higher probability of taking place. 590.35, the top of the CPI gap at 589.25, becomes a reality. So we can clearly see the path for up and downside here. If we take out the intraday anchored VWAPs as well, you'll make note that we have sliced right through all of them. We've adjusted to the new all-time high here. We are clearly underneath that, and notice that early in the week, it's likely going to offer confluence near 606.75. So one more time, any lower high rally attempts that start to reject here, concerning. 603.25 on the hourly time scale. On the daily time scale, any lower highs underneath 606.75 also concerning. What you would look for is here on the hourly chart, some semblance of a double top. You could look for a micro head and shoulders on the 5-minute time frame chart, an hourly inverted hammer candle, right? These things would start to indicate more of a bearish slant for the market. Now, if the market sweeps to the lows, does something that looks like this, that's where we might be able to participate in the counter trend move, where we're looking for longs from, let's say, point A to point B. At point B, are we overstaying our welcome? I would just reinforce one of the ideas we mentioned on the daily time scale, which was just that every single trade is its own trade in isolation when the daily trend is neutral and we're inside the midpoint of a consolidation range. So A to B, great, we have a long scalp there, but I would not overstay my welcome on the long side at point B. The next trade to persist would be something like this. And again, we would look for point B to, let's say, point C. That's a potential outcome. At point C, we do not overstay our welcome, and it would even be reasonable to, again, start looking for a double top and then a reversal from, trading now from C back to point B. And then we would watch from B to A, so on and so forth. So these trades are top of mind as individual setups in the context of a daily neutral range now that we have this big sell side move from the Friday session. Another simple method of analysis that we can talk about here, I'm just going to remove those intraday anchored VWAPs. A simple method of analysis that, really you don't have to overcomplicate this in the market, right? Is just put a Fibonacci on the Friday range. And, this is just awesome how it aligns beautifully, 61.8 and the 38.2 at the key levels. But make note on, let's just say Monday, or make note on early in the week, where do we, how much of a retracement, if any at all, into Friday's range do we get? If the sellers keep it under 38.2, it's a bearish rejection, right? I would probably favor more of a Brigade bolt that looks like this for further downside. If the market has no problem getting to the 50% mark, getting over the half back, as we would call it from Friday's session, maybe this even becomes a reasonable outcome where a recapture of 606.75 drives price towards the upper edge of the weekly expected move. So as I'm going through all of these different scenarios, I'm almost catching myself in real time, starting to think okay, almost anything goes inside of this balance box now, considering the breakdown and the lack of the buyers being able to defend the short-term trend up and over 606.75. And, if you comment down below, and I'm sure the keyboard warriors will be down there this week, oh my God, he's just saying it could go up, it could go down. That's exactly right. That's literally the outcome that you get when you're dealing with a daily neutral trend in this box. As we'll see through some supporting evidence, and I think we should probably speed this up and start to get into it, there's probably a little bit more of a bearish edge out there after the damage done on Friday, so let's talk about it. If you're not familiar with the internals dashboard, take a look at the video tutorial in the top right-hand corner. What do we see here? Substantial volume outflows absolutely on the Friday session. Now keep in mind, it was also an OPEX, right? So we'll have that as the backdrop. Anyhow, substantial move from opening near trend higher zone. When I was talking about, we went through that 5-minute exercise of okay, where is the base case in jeopardy, right? When we opened on the Friday session, this was looking pretty good. When I said that the buyers really, opened in control on the Friday session, the internals reflected that as well. A pretty strong open out of the advanced decline line. We opened over the zero mark on the volume flows. Typically, we open very close to zero anyways, but over or under is fairly important. If you take a look at the tick as well, let me zoom in on this. You can see that the opening tick of the session was actually up here, right around 930, 950. That's a pretty decent opening tick. So the fact that all of these internals deteriorated so substantially, you can see that the cumulative build here, it's not quite at our 5,000 threshold, but it certainly drives down to negative 4,000. That's getting pretty close to substantial. There was some pretty serious sell-side activity happening here at the exchange level. So now it's a matter of almost looking at the market on Monday and seeing if we continue to see that even on counter trend moves. So if you want the golden ticket to determining whether or not we're looking for a lower high or not, any sort of counter trend rallies that happen here, ideally you want them happening on extremely lackluster internals. And we even talked about this divergence on Wednesday, right? As the market rallied on the Wednesday session there, we had said, hey, this is kind of odd. The volume flows were negative. The advanced decline line was negative. And if you take a look at the cumulative build, it was negative as well, with a majority of the morning session being underneath the zero mark. So we had some red flags, which we described on Wednesday, and we said, it's probably not a concern yet because price is what pays. But ultimately, these divergences have played out. So we want to watch for the same thing. Any counter trend rally that looks like, mildly bearish internals, just like what we had on the Wednesday session here, and over here, that's probably a decent indication to be looking for a lower high and change your tune. Now, of course, if the market internals are bright green, lit up like a Christmas tree, oh my goodness, the volume flows on Monday are over 300 million. If the advanced decline line's up here near 1,500, closing near 2,000, if the cumulative tick is nice and strong over 5,000 with a steady build through the session, because we don't just want a short squeeze, right? And this is something that you can carry forward. If you see that the cumulative tick looks like this, strong out of the open, then fades into the afternoon, that is 100% a short squeeze only, not new money buyers. You really want a 45-degree line here out of the cumulative tick, indicating that all day through the session, you're getting a majority of acceptance over the zero mark. So if you see that, where this thing's lit up green like a Christmas tree, okay, maybe we lean into a little bit more of that neutral stance, not leaning into the bearish, oh my goodness, big crash is going to get follow through from the Friday session. So hopefully these are actionable things that you can carry forward and implement into your trading, not just talking about levels, but a little bit deeper than that, right? It has to do with market context. Let's take a look at the market profile for the ES. Here we go. If you're not familiar with market profile, check out the video tutorial in the top right-hand corner. All I would say about profile, it's really aimed to keep it simple here, is that there was an incredibly poor low from the Thursday session that has been repaired. And notice also that value is clean to the downside, point of control, big drop to the downside. So the sellers validating the action down here instead of leaving the point of control. It looks like it might have been, or had the opportunity at least, to be left somewhere up there. It just simply didn't happen. Price moved lower, point of control, value moved lower, much more of an indication that these sellers are getting follow through and they mean business, right? Stronger sellers without much volume, usually that's easier to retrace. Now, of course, there's a number of little zones in here of single prints, and you can carry this forward. I'm not going to go over every single one of them, but these areas in here should be thought of as thin structure, not much volume commitment at price. I would say if you are going to, if the market's really going to make a stand and turn around here, you would just want to see price acceptance over the value area high from the Friday session, and that would be up and over about 60.96 here out of the ES futures. It's almost on par with our 606.75 level out of the S&P 500 cash. With that, let's jump on over to the nasty NASDAQ QQQ. Let's scale this thing up to let's go to a weekly time frame chart. Let's have a look at the clean drawing set. Here we go. So in terms of the analysis, and we'll get into more supporting evidence, I'm primarily concerned with sector posture as well when it comes to the S&P. We'll get there in just a moment, I promise you. If we take a look at what's happening in the NASDAQ, the weekly time frame, what do we see here? Solid red-bodied bar, absolutely very similar to the S&P 500. If we think about candle location, we do have that higher high as well as the higher low. If we think about the overall trend count, we still have lows, higher lows, higher lows, higher lows. This is possibly a soft set of higher lows, and we're still above that. We're pulling back from the highest high in the trend count. So just like we described on the S&P 500, the higher timescales really aren't in jeopardy of a massive trend reversal yet. Now, you could make the argument that in the NASDAQ, we'd had much more of a sideways consolidation range where you could start to consider this, look above and fail, in theory, should start to target the bottom end of the range there towards the equal lows. We would be concerned, I would be concerned in particular, we've been talking about this level. If you want to get really precise, it's 503.25. If we break underneath that level, that's where I would say the weekly chart is in trouble. And oh my goodness, let's buckle up. It's probably going to turn into something more severe for the market. As of Friday's close of last week, we're just not there yet. So let's not prematurely jump the gun here on the higher time frames, right? One of the worst issues in terms of long-term performance in the market is over trading, right? So when we're analyzing on the weekly time frame scale, keep in mind that the time frame of analysis needs to match the time frame of execution. So let's not overtrade our long-term accounts. There's really nothing here that's shown us that, oh my goodness, the market's going to crash yet in the QQQ. All right, let's come in with a couple of fibs. Let's come in from here, and let's come into here. And, it's totally fine. If the market does end up crashing, let's just throw this out there as like a disclaimer, right? If the market ends up crashing and, let's say, oh my God, it goes to zero, right? The hindsight heroes can come out and say, hey, it was so obvious in hindsight, and that's fine. But we'll just be exiting here, right? And that's no problem. But the flip side of that same coin is that over trading concept I was just mentioning. What if this just ends up stacking as a higher low and we go on to make new higher highs? Anyone who's short the market gets stopped out. Anybody who sold their long-term position starts questioning, okay, should I jump back in? Should I not jump back in? Should I wait for a confirmation this? Should I wait for a confirmation that? The next thing you know, you're out of the market. You don't have a clear sign to get back in, and you miss out on a 24% year like what we had last year in the S&P 500. So just, food for thought there when it comes to managing long-term accounts. Anyhow, over the Fibonacci 38.2 here, obviously, as well as over this one, also very similar to our S&P 500 weekly anchored VWAPs above the entirety of the stack. One more time, higher time frames, just not seeing the evidence here that's aggressively suggesting, oh my God, the market should crash, burn, and go to zero. Let's take a look at the daily time frame scale. QQQ NASDAQ. Let's see what's going on here. So weekly expected move is suggesting that lower high, very similar to the S&P 500, also suggesting that lower low. So bearish from a weekly expected move perspective. And on the QQQ, we can start to look at this as the overall balance range. We do have a look above and fail as of the Friday close back within the range. Notice that Thursday, very similar to the S&P, started to suggest buyers were stepping up at the proper level, right? Again, the point here is not to say like, oh my goodness, we should have been shorting the market up here, because prior to Friday breaking down midday through that Thursday low, the market was still exhibiting all of the bullish signs that we were looking for to get follow through in the upward direction. So never confuse outcome for process. I think that's something very important here as well. If you're looking at this with the benefit of hindsight, then yeah, of course it makes sense to be short on Friday's open and hold it into Friday's close. What if the market played out the other way, right? One more time, don't confuse outcome for process and having some repeatable strategy. Anyhow, 533.25, certainly breaking down, getting the close underneath. No support here as well, which is fairly telling. Over the top of the two-day balance range, it was a little bit further away than what we had in the S&P 500. There was much more of a clean, if we just quickly flip to the hourly, so you can see this, right? There was a cleaner interaction off of this level here, 530.25 in the QQQ NASDAQ. The fact that there was not even an attempt for buyers to step up at that particular level does strike me as being fairly bearish. So if we just go back to the daily now to talk about the overall trend, you could still say something like we have, lows, higher lows, higher lows. If you really want to split hairs with me, you could technically call this a higher low, but after the break to the all-time high, I really would have preferred to see the NASDAQ not get a close back underneath 533.25, or at least hold support over the top end of this consolidation zone here, which we just talked about at 530.25. So I'm a little bit back in the neutral stance of the NASDAQ, back inside of this balance range. If you do want to play out the full entirety of look above and fail, in theory, any lower highs or price acceptance in the range underneath 530.25 should, again, in theory, if the market is going to break down here, target the bottom end of the balance range. That's the way that the balance rules should, in theory, play out. So we'll watch for that, but I would maintain a similar stance as to what we talked about in the S&P, where just every single trade is going to be its own trade from level to level in isolation back inside of this box. Remember what we had talked about, again, for what felt like forever. Anybody who was making big, bold calls, big, bold bets in this box, whether it was up or downside, really was not rewarded, right? So big, bold bets will not be made inside of this box, right? It seems as though we had not gotten follow through to the downside. Now we don't have follow through to the upside. I don't know how you could maintain anything more than just a neutral stance inside of the consolidation zone. So again, level to level trades from the hourly time scale, larger time frame traders really, like if you're like a weekly timescale trader, you're probably looking at this and saying, okay, we failed to accept out of the box. I'm probably just waiting for trades. Then you'll look for either an attempt again that accepts out of the box, higher low holds over 533.25, or you just don't get involved in the box and you wait patiently for this. If the market's going to break down and go, what did we just talk about from the weekly timescale, right? We really need that move underneath 503.25 is technically the level that we'll put back on when it's appropriate, but that starts as we were almost going through the 5-minute exercise. The beauty about trading is that it's all fractal, right? Depending on your time scale. Like one of the first warning shots across the bow from a higher time scale on the NASDAQ would just be acceptance under 510. So, as we talk about markets that are sort of sideways in this range like this, there's so many different outcomes to potentially consider and weigh the risk. So I feel as though it's very important to truly understand your time frame of trade. That way you can make the proper decision, right? In here, this could all just be noise to a larger time frame investor. Whereas, for traders, sure, there's going to be great opportunity off of 530.25, 526, 522, 518. Like all these levels can do something for us. So please, as the market remains volatile, because right when we thought we were out of the woods, we're not. As the market remains volatile, please just remember, right? Know your time frame of execution, and also lower your position size. If you're a trader scalping around in this range, as volatility increases, your stops get wider, your targets also get wider, but your position size should also come down. Anyhow, enough sort of pontificating about trade concepts and theory. Let's get a little bit more nitty-gritty here with actionable outcomes in the NASDAQ. We had sort of gone over it a little bit where, if we do get lower high rally attempts under 530.25, that starts to set up what? Left, head, right shoulder, almost identical to the S&P 500, right? Your key daily level is that 533.25. Any lower highs on this retracement that look like this, keep the head and shoulders in force underneath, what you might consider a neckline, maybe, maybe not. Could be 526, could be 522. The largest discrepancy, I would say, between the two indices right now is just that we had not tested the daily 50 SMA here out of the NASDAQ side of things, which is much more of that flush point at 522. The reason I call it a flush point is just because we have much more precision touches back here from in the past. So if the market gets acceptance there, I would definitely be open-minded to this outcome and then the flush point triggering with follow through to the downside, right? So this lower high equally as dangerous. Matt, where's the big bullish outcome? Where do we say, markets are back on the bull side? It's probably a multi-step process, as are many things in balance ranges, but it could potentially stem from something that looks like this, right? Here's our inverted head and shoulders on the hourly. Here's some price acceptance here. I would not be bullish in this case because remember, 533.25 could offer a lower high. But this is where I would start to get back on the bull side and say, okay, on the higher time scales, we're finally accepting again outside of the box. This possibly is a weekly higher low, right? Try to mentally traverse that time frame and understand how relative to the overall ranges that we're dealing with, if this is the last major weekly soft higher low that we were talking about like that, then this would be the next soft higher low as well from that weekly time scale, right? So just trying to put the pieces of the puzzle together. But, just to be clear here as well, it's very reasonable to be looking for the lower high there and also look for an outcome to the downside. So one more time, every trade in isolation here, as I rant and ramble and people say, hey, this guy just says anything goes. Yes, you're right. In a balance range, anything does go. Let's take a look at the nasty NASDAQ internals here. And we'll see what's going on from this perspective. I would echo all the same sentiments as the S&P 500, so no need to rehash everything. Notice that we have bearish action across the entirety of the exchange data on the internals on the Friday session, validating the move to the downside. Let's take a look at the market profile for the NQ. And let's give this a little reset here. One more time, rinse and repeat. Same data points. There was much less of a poor low. Actually, there was a great excess low in B period of the Thursday session out of the NASDAQ. But regardless, the value area and point of control do migrate cleanly lower in the downward direction to reinforce the sell side from Friday, right? You can take a look at these single prints also. There's some in G period here. And there's some in B period up here. So single print areas should be carried forward. And one more time, a simple exercise that you could do on the hourly time scale is just throw a Fibonacci from the Friday open to the Friday low and just make note how much of a retracement, if any at all, do we get into the Friday range. If all price action is under the 38.2, call it for what it is. It's a bear flag. We'll look for this Brigade bolt under 526 for a move to 522, so on and so forth. We'll follow the levels. One thing that's interesting here that I'm just kind of noticing as we throw this on is that the 61.8 is that big key daily level. So if you're only going to have one number on your screen, if it was just like, okay, you can only have one price level, that's it, nothing more, nothing less, 533.25. It has to be on the QQQ. Let's clean that off and let's take a look at let's go on over here to the IWM small caps. This was one of the three major divergences we talked about on the Wednesday update video. And it does appear as though this has played out quite nicely. So as we take a look here, one of the issues we've been dealing with for a very long time, really, ever since this breakdown back here took place, is the acceptance back underneath and inside of this weekly range, which sort of suggests failed breakout, right? Something along these lines. And of course, pattern traders, we can call it a left, a head, and a right shoulder for the head and shoulders. So this lower high that's brewing here, if we take a look at the weekly structure and location, solid red bodied bar, from the top of the right shoulder, or the midpoint, you could even say, of the right shoulder to the bottom end of the right shoulder really starts to jeopardize the weekly for some sort of a neckline break. Underneath the weekly 50 SMA, the blue moving average, you start to look at something like this, back down to these equal lows here, much closer to $200.25, which is also the weekly 200 SMA. So higher time frame bears on IWM have much more to go on than the other two indices, right? If you take a look at this and the overall trend count, it's just simply a lower high, and this to this starts to become equal low. That is not characteristic of an uptrend by any stretch of the imagination. If we take out some Fibonacci's over here, right? First one we evaluate is from here to here. We are still in no man's land between the 38.2 and the 61.8. If we drop the 61.8, that really starts to accelerate, right? The head and shoulders neckline breakdown. If we were to get price acceptance over the 38.2, maybe back to the head of the pattern, but based on last week's structure and location, notice that, again, completely different than the S&P and the NASDAQ, lower high, lower low. It's just much more bearish here out of small caps. And if the small caps are not participating, it's going to make the S&P 500 much more difficult to trade at the highest high. I think one of the concepts that maybe got lost in the very beginning, of the Wednesday update video was just that you didn't want to be the suckers long, right? You didn't want to be the sucker buying at the highest high in the S&P 500. And, again, maybe that got lost in the very intro of the Wednesday video, but man, was that exactly seems to be the right call there. Anyhow, let's take a look at let's go to the daily. Let's take a look at the IWM from that perspective, weekly expected move, and the New Balance range. The New Balance range has been given up, right? So weekly expected move is first. We've got ourselves 223.64 on the top side and 211.99 on the bottom side. Of course, a sustained lower high or even some sort of major lower low from this perspective over here. As we're considering the New Balance range, which those not familiar is this area right there, another rejection of the weekly key level. We saw that on the weekly chart just a moment ago, but acceptance underneath 225 as well after opening above that level. Keep in mind that we've been having this conversation in small caps that, hey, sellers couldn't really run away with it on this gap down. There was no gap fill reversal for downside. There was no gap fill reversal here for downside. I mean, we've finally started to see the sellers step up here. It just becomes a question of, okay, are they going to sustain the downside pressure based on the magnitude of the move, based on the break starting from in range, moving underneath the Thursday low, underneath this low, under the daily 200 SMA, weakness on the weekly time frame chart? To me, the answer would be, yeah, I would expect a downside continuation out of a chart specifically looking like the IWM. I'm much more neutral in the other two indices, but IWM, yeah, this has been a downtrend through and through, even from the higher time frame chart. Let's drop it to the hourly here. Let's get a little bit more nuanced and see what else we can learn. Again, I would say that the buyers had the gift headed into the Friday open, noting that Thursday breaks and technically starts to find a lower high under 225 into the afternoon. The open above that level on Friday should mean that buyers have the opportunity to set the higher low here and now have another look below and fail, just like what we had back in these instances that did not take place. So this is a change in tone out of our market. I think I've been very clear about that so far in today's analysis, but let's just say it one more time to make sure. Let's throw on the Fibonacci here just to go through the same congruent exercise from Friday's high to the lows of Friday. The 38.2 is a key level basically underneath this gap down low. So lower highs that are here, absolutely bearish, looking for follow through. Even the 61.8 is sort of Thursday's low. Rejections of that, also bearish. The only time where I think things dramatically improve for the small caps would be if it starts a new uptrend like this. At least we'll probably have a bearish stance for the S&P 500, still seeking, or at least this will act as a headwind. Let me be very careful with my words here, so there's no misunderstanding. This will continue to act as a headwind, not outright bearish, like, oh my God, we're looking for the market to crash in the S&P, but it will make longs more difficult if we're getting even this uptrend here out of the IWM because of the threat of a possible lower high. It would really require a move back into the New Balance range here over 225 if things are going to become more constructive in the short term for the market. I would say this to act as a tailwind now instead of a headwind, a tailwind for the S&P. So enough about this. Let's take a quick glance over at the good old Russell internals. Let's see what we can glean from this perspective. I mean, is anybody shocked? Big substantial volume outflows, wall-to-wall move on the advanced decliner, and of course a cumulative build that is bearish as well. Seems pretty status quo with everything else we've described so far in today's episode here. Let's take a look at the Rusty through the lens of market profile. This is even cleaner value to the downside. Point of control slammed to the lows. Huge strings of single prints in B period, G period, a little bit of H period here as well. Almost all of the consolidation. You have not only just the volume point of control down here, but the time-based point of control as well, also shifting lower. So Russell, I don't want to say like rest in peace, it's going to zero, because of course there can always be a counter trend move to start things off, but the bears have definitely flexed the muscle over here in small caps, which is acting as a headwind for the S&P as we've sort of connected the dots so far. All right, we've gone into quite a bit of detail through the S&P conversation, the context, the narrative of the market that we're trading in. Let's take a look at the S&P sectors. Let's continue to elaborate here. So who was leading, who was losing, and where was the weight? We see consumer staples leading the pack up 2.28%. What do we know about staples? D for defensive, also a lightweight sector. This starts to suggest risk-off posture. Healthcare, what do we know about healthcare? It's up 1.74%. It's D for defensive. It's the fourth heaviest weight sector, so I'll just put a 4 here for a second. TLT is not technically an S&P sector, of course, but what do we know about bonds? Where do people go when the market starts to get shaky? Historically, right? We didn't see this through 2022. Well, they go to the bonds, right? This is the classic flight to safety trade starting to unfold. So up 1.21%. What about utilities? The most bond-like sector, up 1.06%. Hopefully you can see what I'm driving at here, right? There's definitely a risk-off rotation taking place from the weekly performance. And if you just look at the Friday performance, right? So now look at this column right here. It's still the exact same, with the exception of TLT outperforming the XLV, so those two would be swapped. But nonetheless, consumer staples, the defensive sector, that's where participants are rotating into. That is risk-off posture. Whereas at the bottom end of the barrel, what do we see? It's discretionary, that's risk on, that's underperforming, so therefore you take the opposite stance, right? This risk off posture. Tech looks risk off here. Industrial is a little bit more of a mixed bag. Builders, we'll talk about home builders as well. Excuse me, this is actually materials, XLB. It drives me nuts that it's not just XLM. Anyhow, financials getting beat up here as well. Communications, semiconductors, really not a risk on week whatsoever through the duration of the weekly measurement. Excuse me, apologies for the cough here, as well as the daily, right? The daily as well echoes very similar posture. Even the SMH is down the most, right? So that's definitely a risk-off move there as Friday's breakdown is taking place. So posture also an issue. We made note of this on the Wednesday update video, right? If you stuck through that Wednesday video, we did talk about this. Consumer staples, we took the approach, right? Because at that point, the tech sector hadn't broken down as aggressively, right? It was really the outperformance from the other sectors. We were just making note like, okay, upward pressure, but posture-wise, right? We started to call it a white flag. This is breaking out. So like the next conversation piece to have about the market sectors here is just that we have not seen capitulation yet. Not every single sector is red. And one of the core concepts of okay, when will a bottom be put in place in the market? It's when everything sells off. It's when there is no place to hide. It's when, oh my goodness, this can't get any more bearable. We made this analogy in the past. Imagine getting stabbed in the gut. That feels pretty bad. That's probably what Friday was, right? But then imagine someone twists that knife and continues to just, really, really sort of making you feel it. That's capitulation, and we haven't had that moment yet. You're going to need to see the sectors all red, no place to hide. Maybe the TLT is outperforming, oh God, we got to put the money somewhere, right? We go into bonds. That's the moment when you get that capitulation, when you get correlation, that's where things potentially have the opportunity to put in a bottom, and we have not seen that. So this market rotation could be viewed two ways. Number one, it means that the market's still technically, to some degree, air quotes, healthy, and the market's rotating, and maybe we come out of this with a weekly high or low. Or that's one stance. The opposite stance is just that the market has much lower to go, right? So you pick your stance based on the data points we've covered so far, but this is the conversation we're having today. As we look at the XLP, again, upward pressure. It looks fine in isolation here, breaking out of this multi-day range high. Any pullbacks over 8150 should continue in the upward direction. My concerns where, that knife starts to get twisted is really back underneath 80 for a lower high, something like this. Now you're getting that huge degree of correlation to the downside, right? No rotation for some safe havens. If we look at the XLV, this certainly looks like it's still in play. Over the neckline gets interesting. If that breakout takes place, the rotation lives on. That's over 147.50 into early next week. Concerns emerge if it takes the right shoulder low out, which is currently at 143.75. Let's take a look at the TLT. We'll look at the ratio in just a moment, but clearly this is a little bit, this is just the classic flight to safety move that's unfolding. As Friday was selling off, you could sort of scratch your head and think about, okay, interest rates were down big on the Friday session. Why might that be the case? Because everybody was rushing into bonds and notes, right? So that certainly is taking place. You can see the increase in volume on the gap and go here from the TLT. I wouldn't argue that this is completely a runaway freight train and oh my goodness, bonds are going to rip to the upside. But if we start to get price acceptance over this 89.65 level, it certainly could become the case. One of the things we've been talking about in the TLT recently is sort of this trendline break potential right there. I don't know about you, but we certainly have lows, higher lows, maybe a higher low here, coming into the downtrend after a test already. This is a classic case of buying the higher low and hooking through the trend line on the follow-through move. So TLT could continue to get some love here. If it does, right, what is sort of an idea for the market? Well, you get outflows from equities and inflows to bonds, probably spells more trouble for the S&P 500. Let's move along to utilities. Continues to look just sort of neutral inside of this balance range. We'll keep it moving. Real estate, possibility for a lower high here. overhead supply still in force. I would say the more meaningful one here is the XHB. If you look at home builders, gapping up initially, but then producing a massive and nasty bearish engulfing bar, actually going on to set a new lower low in the overall trend count. So home builders have typically been a bellwether gauge for that cyclical side of the economy. We're also going to get Home Depot earnings on, is it Wednesday before the open, Tuesday before the open, Tuesday after the close? One of those days. We'll take a look at the earnings calendar in a moment. XHB has sort of been sending some warning shots across the bow. With a tech-dominated market, it has not been as influential recently, but the new lower low, remember, in these lighter weight sectors, in this case the industry, we're always cautious of extreme pivot, like new swing high, new swing low. We just got one out of home builders. Moving along to energy, neutral, midpoint of the range. We'll watch to see how that plays into inflation. Moving along to the XLY, big breakdown here for a new swing low underneath the previous low. This is not helping the case for the S&P 500. You could look at it through the lens of a double top or under the neckline. Concerns emerge the more time we spend underneath 219.75. So the deterioration is really what strikes me as notable. If we look at the XLK, comment to make over here is just classic range rules, balance rules are in play. Let's zoom in a little bit more on this. Really, as of the Wednesday update video, right, we were sort of making the argument that any higher lows sort of over 237 would keep this in play for further upside. Clearly on Friday, breaking through the 50 SMA, closing underneath 237, concerns emerge. Now, is this outright like market's got to crash, market's got to go to zero? Not there yet. I would certainly make the argument that the failure at the all-time high is undoubtedly bearish, right? Look above and fail should, in theory, target the bottom end of the range down here on any lower highs underneath 237, right? This down to something like this. That's bearish pressure for the S&P 500, but is it really doing anything to break this range? I mean, we've traded down here before, and we've seen buyers step up off the bottom end of the range. My real concerns for the market would emerge, and again, you can traverse these timeframes mentally, would really, this is like, oh my goodness, let's duck and cover. Market's about to get really nasty here underneath 226.85 after, again, walk through the narrative and the sequence here. Failure to break out. Okay, strike number one. Strike number two is probably the lack of a higher low hold over 237. Okay, we should expect a rotation to here, but if buyers step up, then we'll hang on to a little bit more neutrality. That becomes like strike number four at that point underneath this area. So depending on your time scale, depending on how many strikes before you're out, these are some sort of thoughts and ideas to be considering over the next little bit. As we take a look at industrials, big lower high, I would start to become more concerned on this one. As a matter of fact, we just probably are underneath this low. Remember that we were dealing sort of with range compression, these lower highs, but also the possibility for these higher lows. The fact that Friday sweeps this, a little bit more concerning, probably a headwind for the market. Materials, failed breakout happening here, probably mirrors that XHB. XHB is even more aggressive to the downside. Financials really getting beat up on the Thursday session. We'll take a look at JP Morgan in just a second on Thursday, but still inside of this balance range. I think there's an opportunity here for maybe some sneaky action on a look below and fail under 50.70 to possibly rotate towards the top end. Now, of course, it requires the break and then the higher low back above. Please don't get me wrong. If we break and set a lower high underneath, I'm not going to be sitting here twiddling my thumbs saying, okay, I'm waiting to long financials. I'm waiting. I'm still waiting. I want to long this. Don't get me wrong. If there's a lower high underneath, we'll call it for what it is, and there will be overhead supply. So watching 50.70 very closely this week out of financials for a thin structure retracement. Remember, this is the big earnings move out of JP Morgan and the big banks. Under 50.70, there is some thin structure. I would expect 49.60 and the top of the gap at 49 to come sooner rather than later. Communications look okay here. Not bad, honestly. We have a retest of the previous all-time high as of Friday's close, and really not that bad, pulling back from the highest high with an opportunity to continue the uptrend here, preserving a higher low. The ideal one, yes, would have been over 103.75, but not bad. So XLC, one data point so far that we've looked at where we could say, hey, this isn't the worst thing in the world, whereas everything else is a little bit more on edge, ready to potentially change some trends there, notably some concerns out of technology. And lastly, we've got the SMH Semiconductors ETF. What do we see here? Back inside of the balance box, and also, and unfortunately also, underneath 251.50 as of the close on Friday. So the one comment I would make, out of semiconductors is that historically, this has been a heartbreaker. Let's take off the bear goggles for just a moment. Let's also put the bull goggles away too. And let's just breathe and let's say to ourselves, where are we in relationship to this box right here? 237, 256. Where are we? We're in the midpoint. We're technically at the moving average cluster. Have big bold calls been rewarded inside of this range? And I'm very intentionally slowing things down here, right? So we just like drop the emotions for a second. Might not be as entertaining, but this is reality. There's really been no substantial move in this box. We have failed the breakout now, 5 times? 1, 2, 3, 4. This is the 5th. But sellers also haven't gotten follow through at the bottom end of the range. So am I going to sit here and try to make big bold calls in the midpoint? No, I'm just not going to do it. So it's possible that a rotation to the bottom end of the range acts as bearish pressure intra-week for the S&P 500. That's a possible outcome. It's also a possible outcome that we catch ourselves for a higher low here and some funny games are played where we've seen these overshoots before. We've seen the overshoots to the upside. We've seen some overshoots to the downside here, some overshoots to the downside here, some overshoots to the downside here. Could we overshoot the top of the gap or really just the breakout point and then come back in? It's possible. It's definitely possible. So keeping a very open mind to semiconductors. There's not been a clean trend here in a very long time. With that, let's take a look at the ratio charts. Let's get the energy back here. Let's make sure that we're having some fun as we're going through the analysis as well. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner on how to set up ratio charts and think or swim. What do we see out of the XLK? It's really, it's a mild pullback, yes, and it's at a flattened 50 SMA, but is this suggesting like, oh my God, pack it up and short the market into oblivion? Not really. Not really. Same thing here out of financials. A little bit of an uptick on the Friday session. Not really all that bad. So let's go neutral. Let's go neutral. This is, of course, a concern. We'll put an X. This is a little bit more neutral, remembering that healthcare is defensive. This looks okay. Communications still look okay. This is where we run into trouble. This looks pretty bad in terms of the, relative performance out of consumer staples as well as utilities. So going back to the weekly performance of the sectors, this sort of sums up sort of that risk-off rotation we've been describing. If we take a look at the specialized ratios, whoa, there they are, we've got ourselves a little bit more of a substantial rollover happening here. Still just a very wild balance range. Not aggressively bearish yet. This looks a little bit more concerning with the possible lower highs rolling over under the 50 SMA. This is more concerning here, and this is more concerning as well with the more substantial lower high. If we take a look at the ARC relative to the S&P 500, is very optimistic about this breakout over here. The fact that this has reversed so firmly over the last 2 trading sessions of the week does give me a little bit of concern as well. So you got to check in on these data points fairly regularly, right? You can't just it's not enough to just analyze them one time and say, okay, the market's bullish for the next 6 months, right? Just have changes on a day-to-day basis. That's the fun of the market. Dixie, dollar is pretty flat in here. No big takeaways out of the dollar. I would say if it's going to catch itself for support, it should be here on the higher time frame weekly. Let's drop it down to let's go gold here, actually. Gold is breaking out through this relative high, which continues to signal sort of a flight to safety, risk off sort of indication. We talked about the possibility of a pullback off of this previous area of resistance, obviously not taking place. Gold performing quite well relative to the S&P 500 does look a little bit more like a flight to safety. Let's take a look at interest rates. We sort of described this based on the TLT, right? They are down, but it's probably not based on hey, inflation's going to subside. It's probably more based on, okay, people were buying notes, people were buying bonds. That just sort of compresses from a technical or mechanical perspective the actual yield on the note. Let's take a look at, let's go inverted ZT. Let's take a look at the Fed tracker tool in just a moment as well. Backing off here, indicating that, hey, market participants are concerned about one or two things. Number one, inflation is going to be a non-issue, or, which I think is less likely, or number two, whoa, growth is slowing down a little bit. Maybe we need a little bit of a rate cut here to stimulate the economy. So no more of that rate hike, let's combat inflation in a big way. Let's take a look at the Fed tracker tool here, and we'll dive into some of the fundamentals. If I bring up the Fed Watch, you can see that the odds actually shifted lower for a pause from 97.5% odds to 94. So it's still very likely we get a pause in March. That's not the debate. It's just a matter of the market sentiment, right? You can see that the pricing of the first rate cut has been bumped up from July to June. We're talking about 47.4% odds here, the market getting a little bit more optimistic that the Fed could offer some relief sooner rather than later. So why might that be the case? It really wasn't a busy economic calendar last week. Not much going on with the bank holiday on Monday. If we take a look at a couple of interesting data points, though, jobless claims, they did miss the expectation. I'm not going to sit here and say that it was the most concerning print we've ever seen. We're still in line with many of the weekly reads we've been getting, but watching that closely, a miss to the upside there. If we take a look at some other things, it's really the flash manufacturing PMIs and services. PMI here that came in way underneath the expectation. Excuse me. Remember that we're in now a services-driven economy. And the fact that services have been hot on the PMI, you could take a look at the ISM, which is, in my opinion, the more reliable survey, but this one comes from S&P Global, 49.7 suddenly after forecasting a 53. Remember, 50 is the threshold. Over or under 50 represents growth or contraction. A 49.7 on the services side, which has historically been coming in hotter than the expectations. Some concerns about growth, right, start to emerge here. If you look at revised consumer sentiment, big move to the down. So, like, again, the point of the interest rate conversation / Fed tracker tool conversation is just to say the market may be setting itself up here for a little bit of a war on two fronts where, yeah, growth might take a little bit of a hit here, but if inflation comes roaring back, I don't think anybody's going to be happy about that in terms of excess spend and like adding growth to the economy anyway. So the Fed has to navigate this almost very carefully walking forward. And I'm sure Jerome Powell will have some choice words for us as we get the next FOMC bumped out to March. But we'll watch out for it. We got to make sure not to spur back or stoke the flames of inflation while at the same time maybe trying to preserve growth slowly. I think personally, and you can crucify me in the comments section, that's fine, I would rather see the Fed be firm on the stance of inflation versus like jump the gun early on weak PMI numbers, wanting to get growth back in order. In terms of the earnings calendar, excuse me, trying to manage this lingering cough, definitely some asthma-related stuff. Not that you need to know that, but there you go. Anyway, some earnings, interesting names. Hims and Hers, ticker HIMS, HIMS. Thing has gone parabolic, long and strong, quite literally. And earnings on Monday will be just a huge watch through the retail crowd. I think that'll be interesting. Berkshire Hathaway in a new letter. We'll see. I think if we go over here actually right now. Yeah, there he is. There's Mr. Buffett raising some more cash. We'll see if there's any insights to that excuse me, in the earnings call on Monday before the open. Home Depot, as we were saying earlier, there we go. I guess we got it wrong on all counts. I was saying Wednesday before the open, Tuesday after the close. It looks like it's actually Tuesday before the open. We get Home Depot. That'll tie into the XHB conversation we had. Kava's an interesting one here, but probably not going to move the needle. AMC apes are going to do their thing. They're going to make a bunch of noise and probably fade off into oblivion. I hope they prove me wrong someday, but it just hasn't been the case. Lowe's is going to make a move sympathy to Home Depot on Tuesday before the open, so don't expect much on Wednesday before the open from them unless the report is totally in the opposite direction and for some reason they're doing much better. NVIDIA is the main show. It's the main event. It's on the Wednesday session after the close here, watching that very closely. Obviously, the market will be as well. Law of large numbers and some of the DeepSeek stuff maybe starts to pose a threat. We'll see what the acknowledgement is through the actual conference call. Look out for the Wednesday midweek market update coming after the call so we have that information. We have Snowflake as well, C3AI, the main pure play AI company. CRM, I would say, really on Wednesday, it's these and these right there. Everything else is sort of a nothing burger. IONQ might get some love considering what's going on with Microsoft's announcement of the new quantum chip. I believe it was on Thursday or Wednesday afternoon into Thursday and so on. So we'll watch to see if IONQ gets a little bit of love or has any announcements really for anybody through that time frame. Any other honorable mentions? SoundHound's an AI play. Dell is interesting from a hardware perspective. Rocket Lab is going to get some interest, as well as Archer from the retail crowd also. Just some names to watch out for. I really don't think any of these other than NVIDIA, Snowflake, and Salesforce will move the needle for the market. Fubo on the buyout, or at least merger, I think that was the big news previously, already priced in at this point. So moving along, we don't have a report from FactSet this week. We'll take a look next week after NVIDIA reports, and we'll see what the final numbers are. It's really the finale of the earnings season anyways. Let's take a look back at the indications for our market. Let's go out to the TLT ratio. Let's see what's happening here. So no shock, right, that the flight to safety risk off style trade is unfolding here. What's really notable is that this is holding a higher low and it's ever so slightly made a higher high as of the Friday close. If this can continue to spend more time over this previous pivot high, I think the flight to safety trade is still on. And of course that would do what, right? It takes money out of equities and dumps it into bonds over here as that quote safe haven asset. And we'll see if that continues to be the case based on this relationship here. As of right now, again, this is more of a bearish data point for the S&P equities. Moving along to bonds relative to themselves, not really learning much from this chart this week, so we'll move along to credit spreads. Small uptick into the end of the week here, but nothing to the degree where I would say, oh my goodness, the market's going to crash and burn and go to zero. Like, let's save that for another day when these are making new higher highs and cleanly in uptrends. It's just not the case on credit spreads. High yield junk as well. It called the bearish divergence from here to here on the breakout to new all-time highs. We talked about this on Wednesday, but notice what it's doing into the afternoon of Friday. So what this makes me think about is it just an OPEX panic move? Now, I'm not going to put all my eggs in one basket. This is one data point that we're seeing through the entire analysis we've conducted so far today. But we do have a higher low out of high yield junk. Take a look at that, right? So, is anybody going to be like gobsmacked if the market sort of starts to see a little bit of a counter trend move and this is following through to the upside as well? I wouldn't be. I wouldn't be like, oh my, okay, it's fine. That seems reasonable, right? Seems reasonable. I would say though, right, the best thing that could happen here, if you really want to read into this as a bullish divergence, you want to watch this stay on the lows as HYG makes a new higher high over the original pivot from back here. If that takes place, I would read into that as a much more meaningful singular data point in the analysis. Let's continue along here into Bitcoin, because Bitcoin, almost very similar to gold in a sense, is not budging. It's just kind of sideways up here in the range. It's definitely not a flight to safety like, hey, let's sell all the Bitcoin and move along here into safe haven assets. Not taking place. Still over that 92,000. People aren't dumping the Bitcoin yet. So watching that, this would suggest more of a bullish data point or a sustained like neutral stance for the NASDAQ as well as the S&P. Moving along to total breadth, this did deteriorate. This was the fifth divergence that we discovered in real time in the Wednesday update video. As the market was producing the higher high on, notably Wednesday, we actually had a downtick out of new highs versus lows that sustains itself into the end of the week. Not a shock there. Same thing with these flat reads out of the 250 SMAs as well across the S&P 500. If you want a simplified version of this, you could just take a look at the RSP. We are seeing some struggle here at the top of this range, which is of course divergent from the previous all-time high, but one of the things I would call out is if this just remains inside of the balance range, again, on the higher time frames, I'm not seeing enough evidence where I would say like, okay, we're going to have a breadth contraction crash, we're going to have an inflation-induced crash, we're going to have a this, a that, or the other thing, like a little bit more neutral here out of the RSP if this is just in range. If it makes a break over this, great. That's actually going to help the case for maybe looking for a long down here towards the bottom end of the range out of the S&P. If it breaks down, that's more of a confirming indication, obviously. Moving along to the QQQE, again, pulling back from the higher high. Notice it was a much more meaningful higher high than the NDX weighted. Another data point to carry forward here. It's very possible that this just remains in a cleaner uptrend out of the equal weight, in which case we don't want to jump the gun on that bear side. So trying to take a very even-keeled approach to today's analysis, regardless of how you feel about the arrow on the thumbnail of the video, right? You could use that almost as like someone was going to invent the inverse TB indicator to inverse the direction of the arrow to make a call. Regardless of how you feel about that, trying to keep it even-keeled through these additional indications. The transports have been massively divergent to industrials for a while. Excuse me. We've seen that this hasn't been really fruitful for the analysis. So there it is. It still is divergent, but take that maybe with a grain of salt. The VIX, there it is. We talked about this in a number of pre-market prep episodes, just saying like having some long exposure to the VIX or just volatility in general is probably worthwhile. We were saying for different reasons, obviously administration tweets, but hey, anybody who's long VIX got a little bit of a payday there on the Friday session off of that 15 floor. The big question for me just becomes, okay, what are the like derivatives, or it's actually the opposite. The VIX is almost a derivative of the volatility futures. We'll talk about that in a second, but what is the VVIX, volatility of volatility, doing? It's like it's hardly moved in the upward direction. So, as I think about, hey, have we seen capitulation? Is this the end of the crash? VVIX would say absolutely not. This is like, it's mildly higher, but until we're over 120, until this thing is red hot, until the VIX is up, right? Just because the VIX is a little bit more of a easier reference point, right? Until the VIX is, 40 plus, you're not seeing that capitulation style bottom. So I would not just go out there and try to quote buy the dip yet, calling for a capitulation bottom if that's the style of pullback buy you're looking for, seeing the volatility components like this. Let's finish up with the VIX futures. And I primarily just want to full screen this. This has been our go-to over the last couple of weeks. Excuse me. Notice that they're all still in contango. And for anybody who doesn't know how to, doesn't know what this chart is all about, we'll just quickly go over it over here on the VX futures. It's mapping the difference between, we don't want that, covering what we want. Here it is, the last, right? It's mapping the difference between these different contracts. And basically what you want to see is lower volatility in the current day than, excuse me, than you do priced out further in time. And what that does is really two things. Money managers feel much more comfortable allocating capital here when volatility is known to be lower versus some unknown future, right? Instead, like if this inverts, basically if the relationship inverts, if these numbers get negative, and we've described this a number of times, so apologies if you're hearing this for like the second, third, or fourth time. If these numbers get negative, then suddenly what does that imply here out of the curve? Well, there's more volatility right here, right now in the future, in the present day, than there is in some potentially unknown future. So why would we allocate capital here when we can just wait for this over here? That's one of the mechanics of watching the vol curve. The other one is just simply based on the way that market makers hedge. If this is in contango, market makers hedge a different way than when it's in backwardation. And when it's in backwardation, it's much more like, okay, market's selling off. We've got to go with the flow instead of let's hedge against the flow, right? So in terms of seeing these spread the way that they are, it's not overly indicative of, number one, capitulation on the low, and like this is it for the final flush, and therefore maybe it's okay that the weekly time frame charts can produce some sort of higher low so long as these remain in contango, basically in positive territory over the zero line. So if that was too much, then like don't worry about it. This is just like one data point in the full thing that we've gone through in today's episode. I think what's much more meaningful is going through the core list of companies. Let's see what the components look like for our S&P. NVIDIA earnings on Wednesday means that the Friday expiration contracts, let's just go through the exercise. We do this whenever there's a big one. If we take a look at the implied volatility rank, not just the implied volatility, but the rank, you need to know what it is relative to other sessions, right? Implied volatility rank is quite high relative to these previous sessions. This, of course, was very high back here when this drawdown was taking place. This is DeepSeek, of course, back here. Excuse me. We're on par with DeepSeek implied volatility. So what does it mean? If you're going to be a straight up call buyer or a put buyer, then you're going to need an expansion of implied volatility, or you're going to need an outsized move relative to the not weekly expected move at this point, but the market maker expected move on Wednesday after the close. You need to beat that if you're going to get paid on your options contracts. If we come in shy of the market maker expected move for earnings, you will just be nothing more than, theta collection, implied volatility crush for the market makers. That's it. You're just throwing money into an incinerator if you buy this and price remains within the expected move. So, am I a fan of trading options with elevated IV ahead of a binary event like earnings? The answer is no. It's always been no. So, with that understanding, NVIDIA is going to be like a touch and go before earnings. We're either going to have a quick trade on Monday that plays out and great, we'll just one and done, or it's just going to be nothing to do on NVIDIA. So understand that. If you're trading shares, obviously that's a different story. Let's go back to our daily moving average set here, and let's take it back to the analysis. Excuse me. So, is there anything wrong with the NVIDIA daily chart? To me, the answer is no. We had this, DeepSeek capitulation move to the downside, look below and fail, to the top of the range, higher low above the range. To me, it looks like an opportunity for potentially, and again, this is unknown as of right now. We closed right at it on Friday, but what a place for a potential higher low, 134.75. If you take a look at the hourly time frame chart, you can see it much more cleanly, right? Take a look at this level right there. If the market turns here and continues the stair step in the upward direction, is that not a very logical place for it to do it? Of course it is. So any look below and fail, any higher low back above the range, I would look for a retest of the bottom of the, excuse me, really dying here with this. Got to go get the inhaler. 138. Jeez, can't read apparently too when you have asthma. Back into 141.75. That's a potential upside trade here pre-earnings. Again, on Tuesday, am I interested in that? Probably not. Wednesday, absolutely not. After earnings, maybe, but earnings have the potential to obviously cause like gap up, gap down. Let's reevaluate the levels. We'll take that in stride. Moving along to Microsoft. Announcement of the chip for Quantum, of course, and then what? Falls flat on its face, back down to the bottom end of the range here. It's just, Microsoft is there's nothing to do. Nothing to do on Microsoft. Maybe there's some short trades to take if we're under 403.25. It's not been fruitful to trade in this range. It's really been a pain in the behind all through this balance that we've been dealing with, so we're moving along. It's going to get booted from the core list of companies pretty soon. I could never. What do we see? Apple. Inverted hammer on Friday. So first thought is potential for a pullback. I would love to see a higher low offered here. Apple did not, crumble like the broad market did. A little bit more of that slow and steady grinder. So if we do get this, I don't think I would take it short through this consolidation chop, but I would be looking for a higher low at 241.25. Daily would play nice, right? If we get something that looks like this, maybe over time it's double bottom, and we know the neckline is up here for the follow through to 253.25. So patience out of Apple, looking for the pullback first, would ideally like the long for risk, reward, and then ballooning runners, something along those lines there. It would still be okay. It wouldn't be the end of the world to catch a weekly higher low here at 237.25. Moving along to Nancy, obliterated on Friday, underneath this as a range. Looked into this gap here, closed back above it. So I'm carrying that forward as an interesting nuance early in the week. But what's going on from a daily trend perspective? Highs, lower highs. These were lows. Ideally, the higher low was at or above that. We were trying to give it the benefit of the doubt here near the 250 SMA, the blue moving average. No dice, right through it. And as of right now, I would say that the short-term daily trend is, in fact, down with these lower highs and lower lows. So any counter trend moves, looking for another lower high to be set. 224 gets interesting. The ideal one is just underneath the 50 SMA on the retest, 228.75. Here it is on the hourly time scale. One more time, this is the first, and then this really just keeps this as overhead supply, and we will look for buyers to sell for break even. Retested the 50 SMA, probably looking for a reversal there. That's Amazon. If it continues to the downside, let's say that this is prior to any counter trend move. Let's say that Monday opens up and this thing goes boom. I would start looking for a whipsaw trade back to the upside, seeking some sort of counter trend move. You have to be very precise with that type of thing. You don't just want to try to blindly catch the falling knife. So make sure you're someone who can either stick to a stop loss if you're going to try that, or just avoid it in its entirety. Next up, Google. Breaking down from the overhead balance range. One of the things that I want you to keep in the back of your mind as we go through the core list of companies, and hopefully you're doing this already anyhow, is just what are these suggesting for the index itself, right? That's really it. We know that NVIDIA is no longer the top weight, but Apple certainly is. Microsoft is up there. NVIDIA, I think, is number 3 at this point. If we just go over here, we could take a look. That way I'm not lying to you. We have Apple as number 1 at 7.16%. NVIDIA is number 2 at 6.62%, then Microsoft at 5.96%. So those are your top dogs. What does this mean basically for the S&P 500 based on the individual analysis of these names, right? I would say so far doesn't really spell the strongest looking market. Look at Google here. Breaking from its balance range inside the Willow Gap. Would love to see that close. I've been waiting for Google to show us something inside of this gap or inside of this gap, and the time is finally here. So out of Google, I would love to see a lower high rejection to continue trading the Willow Gap that's under 180.95 into 176.35. The time is here. Let's make sure we can execute on some of these ideas. That's something that I'm very interested in. Even if we move over the Willow Gap high and then do something like this into the future, still interested in that idea right there. Why? Because we have a break from a daily balance. This would set some sort of hourly lower high, and then we can just execute if we have clean risk reward up against the levels. 180.95, top watch on Google. Metaverse, what do we see over here? Bloodbath. So Zuckerberg's gains are drifting away. The longest winning streak in the market has been brought to an abrupt halt. Still thinking about the weekly Brigade Bolt. One can dream. Don't crush my dreams just yet. Maybe we get here, maybe we don't. It's a weekly dream. In terms of what's in play right now, sustained rejections of this level at 704.50 do look bearish to me. But do we want to sell this directly on the lowest low? Not really. Not really. I would be looking for a couple of things here. I would love the counter trend move to set a lower high under 694.75. It's the inverted hammer low from the Thursday session. If we get that on the intraday, I think we could start to look for a reversal there. And then, because this is technically still in the context of a daily uptrend, stick with me here, right? What would we like to see happen? Well, what would I like to see happen? I'd love to see this. I would love to see something along these lines and then working its way back into an uptrend over time. So one possible idea, of course, that crushes the weekly dream of this in its entirety, but nothing wrong with a little bit of double bottom on the hourly here anyways, back to get some love like this to creep towards the all-time high. So watching that on Meta, let's go to Tesla. The conversation here has been pretty firm over the last little bit. I don't think that anybody should be shocked. We've been talking about the lower highs. We've been talking about the lows, lower lows, equal lows, right? Lower low happening here. We've been seeking a lower high anywhere underneath 377, and that's exactly what's sort of been taking place here. One of the conversations we had was if this turned into, and you can go back, you can watch the Wednesday midweek market update. If this turns into a Brigade Bolt lower high there's your head and shoulders. Kudos to anybody who took the trade underneath 349 on the Friday breakdown there, went straight to the target at 333.50. So what's the idea going forward? It's a little bit of a wait and see. Another lower high under the neckline is a possible short entry here. If it does just get straight up continuation, you have to be very careful about shorting this into a previous low. And then if we go one step further than that, I would start to think about counter trend moves off of 310.50. So that's Tesla. Moving along to, JP Morgan, crushed on Thursday underneath the balance range here after I can quite vividly remember saying, hey, this thing looks fine. It's consolidating near the all-time highs. Well, so much for that. In terms of the breakdown on the hourly, you can see that all of the consolidation into the afternoon was here. There was a great opportunity for a Stevie Wonder on Friday over 270, did not take place. Obviously, follow through to the downside keeps the bears in control, and this is overhead supply. So any lows that sustain, or any lower highs, I should say, that sustain underneath 270, bears are in control there. Netflix, what do we have out of Netflix? Big retest again of the previous all-time high, which was the top of the earnings consolidation range. I would not long this here after we've already retested it once. The Brigade Bolt was here. It is not here. It is not here. So the equal low puts the daily trend to, we want this, neutral. Lower highs there build out a head and shoulders, something along these lines. And if we were to break the equal lows, the rotation would be here. We'll take it one step at a time through the earnings gap. Remember that this is a false wick on Thinkorswim. I've got two trade ideas for you. Let's start with the lesser controversial. Let's go PGR. PGR, Matt, there we are. No pun intended. And it looks like I have not done my homework, but the idea is still valid nonetheless. 270 is our round number breakout for all-time highs. This is Progressive Insurance. Insurance has been absolutely off the hook, literally. Look at this thing over the last little bit. Insurance is one of the largest stories right now in housing, the housing market, the investment market for multifamily real estate. I would say a little bit less on the, who knows, actually. I'm not as involved in commercial, so I can't speak to that. But in terms of residential, this has been, a nightmare for a lot of people in a lot of different zones where there's densely populated areas that are desirable to live in. So this is not relented. This is a monthly time scale, right? Look at this monthly high or low. Look at this monthly trend. Look at this equal high that's been produced. Now let's drop it back down to the daily, and let's take a look at this. Could this not turn into cup and handle? The reason it hit the watch list for this week is because of the multiple inside bars on the Thursday and Friday session. If this can get a Brigade Bolt out of the inside bars over 270, it's a blue sky breakout after a cup and handle. If this pulls back, what do I want to see it stay above? 261. Let's go 261 flat. Round numbers only up here is fine. At that level, either show me the cup and handle over time. You could call it bull flag as well. No different, right? Or show me the inside bar breakout early on in the week. This is not something to do with shares. If you take a look, this is not something to do with options, rather. Look at the chain here. It's absolutely horrendous. Weeklies, let's go out to some monthlies. Yeah, a little bit better. Be very, very selective with your strikes and look for the liquidity if you are going to do it through one of these lenses. This is horrible as well. It looks like the monthlies for March are your best bet there in terms of liquidity. Let's go out a year. A little bit more consistent through the strikes, but still low liquidity. So my point being is be very careful if you do this with options. The spreads there are going to be very wide, but shares potentially are an interesting idea over 270. We'll watch out for that. The next one, a little bit more controversial, SMCI. He said it, super microcomputer. If the broad market's going to see a little bit of a pullback or some sustained sell side pressure, if the SMH looks like it could possibly come in a little bit, what about SMCI at 50 and 49? What about that, right? Because in theory, you've got yourself inverted head and shoulders on a high time scale, a pullback into this level that supports, hooks for a major high or low on the weekly. All it takes is one news announcement to say like, hey, this whole thing is still a fraud. Nothing has changed. And, this is probably doing that. So play that, size your position appropriately to the risk tolerance you can afford, noting that things can change on the drop of a news headline. And the setup's not in play yet. I'm not saying that there's a buy side setup here yet, but at 50 and 49, definitely interested in a possible retest higher low long there for a Brigade bolt. So that's SMCI. Do what you will with these two trade ideas. That's what I've got for you in today's episode of the Weekly Watch List. I appreciate you if you made it through the entire thing. We had a pretty detailed conversation today, so thanks for sticking with me. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Remember that we will be live for the pre-market prep. We're live every morning that the market's open for the pre-market prep. 8 o'clock Eastern time is when that kicks off. We'll send you, into the day's session with a well-developed game plan with a number of different situations for the market to react to, and it's our job to sort of participate when the reactions align with our anticipated pathing, right? So anyhow, we'll see you back here on Monday morning, 8 o'clock Eastern time for the pre-market prep. Hope you enjoyed this weekend update. Enjoy some time away from markets. Friday was pretty hectic. We'll see if this week upcoming becomes hectic. Enjoy the weekend and have a green trading week.